So the next session is a fireside chat with one of the fintech gurus, Renaud Laplanche. Renaud is the president and CEO of a founder of Upgrade, which is a fintech platform. But Renaud also was the one that who founded Lending Club in 2006. And Lending Club is the largest fintech personal lending. It has become a bank. Now the moderator is Karen Webster. Very fortunate to have her here. She has done a lot of work on payments and BNPL, she's a CEO of Market Platform Dynamics and also president of Payments.com.
Thank you. Thanks, Shalapa. I have bad news for you guys. We are not going to talk about crypto. But don't leave the room. I think the conversation is going to be just as interesting. We're going to talk about where the rubber really meets the road when it comes to transacting, which is the intersection of payments and credit at the point of sale. Renaud, thanks so much for agreeing to do this little back and forth with me on this topic.
I think I'm really excited to talk about the other 99.7% of transactions.
Right, 99.9, it might be 9% of things that are going on. Okay, so again, we're talking about point of sale, the intersection of payments and credit, and we can go back to credit cards. 60 years ago, that was really the innovation. It still represents the cornerstone of transacting today at the point of sale, but certainly there are a lot of new twists to that, buy now, pay later, and installments, which are twists on old things that fintechs have provided kind of a new lens and a new modern interface that consumers really like. Before we get into some of the specifics, Renaud, handicap the landscape today. Who's doing what and what's going on?
Yeah, so at a sort of 30,000-foot level, I think when you talk about certainly sort of payment at the point of sale and credit at the point of sale, obviously the vast majority of transactions, instruments being used are still credit cards. And so there are really two flavors of credit cards. There are transactor cards, where typically no interest is being paid. Those are cards used by consumers who do not need the credit facility, just using the card as a means of payment. And so at the end of the grace period or any time in between, just pay the balance in full. And then you have the revolver cards, which are typically used by consumers who do need the credit facility and really intend to use it as a credit instrument. So these are credit cards. Whether there is interest being charged or not, it is typically sort of, a relationship between the credit card issuer and the consumer. The merchant is not involved other than by paying the interchange, which finances that grace period, the transactor cards. Then so over the last few years, buy now, pay later, BNPL came along and really provided a sort of new set of sort of value propositions for consumers, with there again a couple of different flavors. The sort of short-term BNPL, so the pay in 4 type of PayPal or Afterpay type of products, where it's really a very short-term credit facility or payment arrangement, where the consumer would pay as a purchase price in, say, 4 installments over 2 months, so one payment every 2 weeks, with straight line amortization over 2 months. Typically, also no interest being charged to the consumers, and in this case, there's typically no interchange paid by the merchant, but the merchant often provides a merchant discount that will finance a transaction. And these BNPL providers typically have direct relationship with the merchant, so it's really a tripartite transaction between BNPL provider, the merchant, and the consumer. Then still in the BNPL category, you have sort of longer type of real more like credit facility, things that companies like Affirm have specialized in, where it's more 6 month, 12 month, with or without interest, but typically installment plans where sort of consumers can really benefit from that credit facility, again, paid for by the merchant in part, and spread their payments over some period of time. And then, so you have these credit cards, BNPL, you have the more sort of traditional point of sale financing, so just like credit facility made available at the point of sale. Companies like Green Sky have done a lot of that in home improvement financing, for example. And then you have sort of newer business model like the upgrade card that tries to combine the benefits of BNPL and credit cards, the sense that it's a card, so it's available at millions of merchants, it settles through the credit rails, it has all the consumer protection of credit cards, but it provides an installment facility. So it's, in our sense, it's more responsible, it ends up being more affordable for consumers to pay down their debt over some period of time, could be a year, 2 years, 3 years, but with straight line amortization, equal monthly payment of principal and interest every month, which helps avoid the revolving credit traps of credit cards that so many consumers fall into.
It's funny that we call buy now, pay later a different category, since that's really what credit cards are too, buy now, pay later. But anyway, that's a detail. But there are a variety of options now for consumers, and I think one of the things that we'll get to later in the discussion is the relationship between the buy now, pay later schemes, which includes, I mean, they are installment payments, that's how they're set up, and the financial health of the consumer, how they actually use it. One of the things that I think is interesting about what you guys do is you reward based on repayment as opposed to spending. So hold that thought. But we've done a lot of research over the last couple of years in trying to better understand the profile of this buy now, pay later consumer. And one of the recent studies that we did, we haven't released the results yet, 13% of consumers opened a buy now, pay later plan to make at least one retail purchase over the last 3 months. Median spend is about $350. Mostly apparel and accessories, not surprising because that is really where the starting point for a lot of buy now, pay later players are. But I think one of the most interesting things about what we discovered is that about 2/3 of consumers who have these plans active don't think of it as credit. They think of it as a way to pay for what they purchased. That was an insight to me and a bit of a revelation. I shared this with you as part of the background for this. Did that surprise you? What do you think of that?
Yeah, so it's a great finding, an important finding in my opinion, because something you don't want, right? You don't want consumers to access credit inadvertently, right? Because BNPL, like credit card, is a credit mechanism. And I think you'd find actually the same finding in credit cards, where a lot of consumers use the card as a means of payment at the point of sale, and then inadvertently fall into credit card debt by not paying that balance in full, like maybe intended to at the time of the purchase. So I think BNPL, from that standpoint, as a benefit to credit card, is that you can't really inadvertently fall into this like revolving credit card debt, right? BNPL, or again, installment plans. There's a set payment from the beginning; it's very predictable, and you don't have this trick of paying the monthly minimum payment and just kicking the can down the road and not taking care of it. So from that standpoint, I think even if some consumers don't necessarily realize that they're accessing a credit facility, I think it's not as bad as it would be in the case of a credit card, where you can really sort of put your finger into something that ends up swallowing the entire arm.
It's still a revolving balance. It's just a different way of revolving it. It's a predictable payment every month that I think provides the certainty to the consumer that whatever it is they purchased will be paid in full at the end of that term. And I think that's one of the things that consumers value about the experience. What does that imply, though, for how these products should be developed and promoted?
Yeah, so I think banks and fintech companies both have a responsibility to sort of design products that are truly helpful to consumers. And it's not just out of altruism or doing the right thing. It's also just good business to make sure we serve the best interest of our customers, and then that will make for more loyal and repeat customers. And so from that standpoint, I think product design is really important, and I think product design can shape the right behavior and avoid consumers, again, inadvertently falling into credit for the wrong reasons, into credit card debt. One of the products we developed at Upgrade is called One Card, which is sort of a combination of, it combines the utility of a debit card and a credit card, but in a way that really is trying to shape the right consumer behavior. By having two settings, a pay now and pay later, so the equivalent of debit and credit. And with sort of pay now being promoted for everyday expenses, recurring expenses, type of expenses that consumers should not be using credit for. And then the pay later being for larger purchases where it does make sense to spread the payments over a longer time period. So I think by sort of thinking of product that way as a way to promote the right behavior, I think we have a shot at sort of helping lift our customers to a place where they're using their credit and generally managing their finances responsibly. I think you talked also earlier about the way the rewards, we're thinking about rewards programs. We like to reward consumers for paying down their debt, not for spending. So most credit cards essentially reward consumers for spending and for spending money they don't have in the first place.
Well, they love their rewards, though. They love rewards.
They do, and they're still getting rewards. They just with Upgrade, they're getting rewards for doing the right thing, which is paying down their debt.
Different behaviors. Let's talk about who these customers are, because I think there's a lot of opinions about who they are. There's a lot of data that suggests buy now, pay later are consumers who can't get credit. But I want to share with you again from the same study. In June, it's a national sample, statistically relevant, all that good stuff that our data scientists make sure is appropriate. 1,400 roughly buy now, pay later users. Millennials, high earners, credit score of about 658. Half of them, though, say that they live paycheck to paycheck. Now, there's a lot of debate about what that means. Our definition of paycheck to paycheck is a consumer who can either comfortably or not comfortably make their bill payments from paycheck to paycheck, but they need their next paycheck to actually fulfill their financial obligations at the end of the month. These are consumers who say that they live paycheck to paycheck, but have fine, there are no problems paying their bills each month. Why do you think buy now, pay later is attractive to high-earning millennials with a 658 credit score?
Yeah, so I think that's right. There are a lot of BNPL users who are not necessarily cash constrained or credit constrained, but just want to take advantage of a good deal. I mean, you're getting a payment facility. It's pretty short term, so it doesn't feel like you're getting into credit card debt and into trouble. And it's sort of interest free for the most part. So it feels like, okay, why not take advantage of it?
Well, to that point, we dug a little deeper. Well, why are these consumers using these products? And what we found, again, was really interesting. About 43% of buy now, pay later users, we call them Smart Money Prime. These are consumers with about a 747 credit score. They obviously have other cards in their wallet. They have credit. But they choose buy now, pay later because it's a smart way to manage their cash flow. There's another group of consumers that are similarly smart money. They're subprime. Their credit scores are roughly 585. It's about 12% of buy now, pay later users. And then there's the rest, which is about 45% of consumers who really only want to use buy now, pay later. either out of necessity or out of preference, and they are so committed to buy now, pay later that they would abandon a purchase at a merchant not offering it, or they would go to a merchant that offered buy now, pay later as a way to fulfill their purchase requirements. Their credit score is about 685. So if you look at the array of the buy now, pay later users, doesn't that suggest that what consumers want is they want credit, but they want a predictable way of managing the repayment because that's how they can manage their cash flow and use their money in smarter ways?
Yeah, I think that's exactly right. I mean, what we're seeing with sort of BNPL and with Upgrade card, which is not BNPL but is a sort of installment card, it's really the resurgence of installment lending as a more sort of predictable type of credit, more responsible, one where you don't feel like you might be sort of getting into that sort of revolving debt cycle that so many people have fallen into with credit cards. I think the one sort of danger still with this type of BNPL product is out of that last category, how many consumers really do it out of necessity because they might be sort of maxed out on their credit card, and in that case, it's not responsible to sort of extend more credit to them.
Yeah, I mean, it's hard to know, we'll continue to dig. It's hard to know why not, because they obviously have other products or could get other products, but they choose not to. So are they maxed out on other credit products?
Yeah. There's something that maybe some consumers don't really realize is sometimes there's not a lot of difference between a paying for BNPL product over 2 months and the typical grace period on the transactor card.
Right.
A transactor card, I mean, you get the 30 days of statement period and typically a 21 days sort of grace period. So you get all the way to 51 days, which really isn't that far from the 60-day you get.
But
on
I think it's the discipline, right? I think it's the discipline of having the money, the same amount of money taken from your account, your checking account, over the period of the loan. Talking about installments, so I noted that a lot of the use cases are apparel, accessories, consumer electronics. You see more of. What about other categories, other use cases where the average ticket is much higher? Healthcare expenses, home furnishings, things like that. Where are you seeing the application of installments to those use cases?
Yeah, and so and there's been sort of healthcare financing available for some time now, typically by more traditional players than BNPL. I think some categories where you start being sort of a bit more sort of you want to be cautious, and again you don't want to make sort of necessarily credit available or encourage consumers to get into debt for expenses that feel more sumptuous and completely discretionary. I noticed some BNPL players went into sort of the luxury vacation space recently. And so, I mean, is that a good thing really to sort of help consumers sort of get the $10,000 cruise package that they can't afford as opposed to the $5,000 that they can afford?
Well, I mean, but you don't know that, right? I mean, it could be a smart money way of not tying up a credit line, which you might want to use later, for someone who wants to be able to pay over time. It's hard to know what the motivations are. But I think, what makes buy now, pay later different from the installment products, and even for those fintechs that are tapping into unused credit lines and putting installment payments against that, is that there's a credit line, there's a limit, and consumers know what the limit is. And with buy now, pay later, you apply at the point of sale, and you don't really know whether you're going to get approved or not. Some give you pre-qualification, so I've got $1,000 or $500 to spend on my next purchase. But is that for you the difference, the guardrail that a credit line provides that buy now, pay later may not? and then the multiple uses of buy now, pay later that stack up over time?
Yeah, I think that's one key difference. I mean, clearly, we like the sort of credit card model, the installment credit card model better than BNPL for a couple of reasons. One is one you just described, it's more predictable for consumers. They know what their credit limit is, and they can manage it accordingly. Another is just sort of choice and availability through point of sale. I mean, with a credit card, you're available at millions of merchants through the Visa and MasterCard network, while BNPL is typically still reliant on partners.
Well, that is another question, how to create ubiquity, right? So you see a lot of different ways of doing that. Ubiquity by creating shopping ecosystems where buy now, pay later can be used. And for those buy now, pay later only guys, that's pretty good because they'll shop within that ecosystem. Others, like you described, run over debit card rails, accept it anywhere, and now with one card, you can make a purchase and within a certain period of time, put it on installments. Where do you see the sweet spot for ubiquity, business model, and scalability?
Yeah, so I mean, clearly that's a reason to go with the card model. I think even the most successful BNPL players are capping out at a few tens of thousands of merchants, and it's hard and it takes a long time to get to that level of adoption.
That's your PayPal.
Yes, exactly. Yeah, unless you PayPal and you have a head start. But it's harder to get to scale that way for sure. So we like the sort of credit and debit rails model better. In terms of business model, what's it's going to be really interesting to monitor is going to be what's happening with interchange, right? I mean, clearly, sort of debit interchange has come under pressure in the past. It might again in the future, and then credit now. I mean, if you've seen the last proposal by Senator Durbin, credit interchange might follow the same path. So I think for business models that are too heavily dependent on interchange, that creates some issues too.
So what do you do?
So I mean, the path we've chosen is really to. I mean, we do collect interchange as part of the transaction, but it's a credit model. So we extend credit to consumers. There's an interest rate, fair interest rate that comes with it, and that's the vast majority of our revenue. So we do get the ubiquity of settling transactions through the credit and debit rails, but the vast majority of our revenue remains sort of credit transactions.
It'll be interesting to see how this all plays out. You know, it is one of the reasons that you see a lot of the pure plays developing a broader portfolio of services, like you're doing as well. You know, a banking-like set of services and capabilities for consumers, so that you do build a base beyond just the transaction potential against the transaction-only business model. I want to start to talk a little bit about regulators and what regulators are worried about. And I referenced the concern about consumers having a lot of active buy now, pay later plans and the potential for, getting behind, paying late payments, and so forth. Again, the same data set shows that those consumers who have active programs have about 2.3 programs active. Only 11% of consumers, though, say that they've ever paid a late fee. So I guess my question is, it is a concern, but it's a concern that goes beyond, I would imagine, just buy now, pay later. And just because someone's late doesn't mean they're not able to complete and fulfill their credit obligation. Do you think the regulators are worried about nothing?
No, no, I don't. No, I think I agree with you so far. Sort of credit performance of BNPL product has been okay, but I still worry about the sort of lack of underwriting or sort of lower level of underwriting and the lack of credit reporting. I think that should be really some table stake to make sure that all BNPL providers, and some do already,
And they're doing it, yeah.
and Affirm in particular does, but others don't report that debt. It is a debt to the credit bureaus, and it's obviously a problem for other lenders, and that might extend too much credit to these same consumers not being aware of their BNPL payments.
Right.
And it's a problem for these consumers who, again, will face too much availability of credit that might not be good for them.
There is the tendency to lose track because all of this is very abstract now for consumers. Everything is digital, and being able to manage flows is important. But I think all of this really tempers the reaction, which is not everything is bad, and not every consumer who uses buy now, pay later installment programs is a poor credit risk. Speaking of worrying and risks, where do the banks fit in? Because I think about this space. I think about the data that we've seen, which shows that people are using buy now, pay later or installments as an alternative to credit because they want the predictability of the payment, and they have credit which they could use, which they choose not to for whatever reason. Where do the banks play here, and what would you advise banks to do?
Yeah, so I think banks have a great opportunity to partner with fintech companies, with BNPL providers, to offer the same products to their consumers, and not see sort of customers just walk away for this lack of product availability. I don't think it's necessary for banks to necessarily reinvent the wheel and create their own product. I think that most fintech companies are happy to partner with banks. We have 165 bank and credit union partners now.
Wow.
And these partnerships are running really well, and clearly there's sort of additional sort of regulatory burden that comes with these partnerships from the fintech side, but it's also sort of expanding the universe of customers we can reach.
But what keeps banks from doing what you're doing, which is I put something on my debit card, and I have 24 hours to decide whether I want to pay over time? Why don't banks do that? Is there a regulatory impediment?
No, I don't think there's a theoretical reason why banks couldn't do it. I think it's more of a practical reason of sort of just a lot of the DNA, the innovation DNA, sort of not always being the most prominent within banks, and I think fintech companies. That's what we think about all day, right? It's about customer experience. It's about removing friction. It's about creating that flow that's going to deliver the best possible experience, and then managing the risks. And so I think it's a bit harder for banks coming from typically sort of older technology infrastructure that has been sort of built over time, and sometimes is a result of multiple rounds of mergers, where there's not always a single view of the customer. There's not always the physical and digital infrastructure that's really sort of maximizes the potential for innovation. So I think there's no fundamental reason why the banks couldn't do it. I think for all these legacy reasons, it's often more economical and more practical for banks to partner with fintech.
I mean, it isn't as if banks aren't doing anything. I mean, you do have the ability to plan it, or whatever the issuer's version is of that after the fact. But it's after the fact. I mean, I think one of the innovations that Buy Now, Pay Later has put forward is to think about how you're going to pay for something before you buy it. And I do think that that has changed for many consumers, how they think about their relationship to credit. And I do think that that's healthy. It's, is this something that I can pay over 4 installment payments, or over the next 6 months, or over the next 12 months with this predictability of payment? And I think it causes consumers to think about that. Can I do that? Do I want to do that? Am I going to be able to do that? And that fundamentally changes, I think, the relationship that consumers have with credit. So with that, how do you think that that is going to influence the design of credit products over the next couple of years?
Yeah, so that's another sort of great example. I mean, you're right, just the availability of that product helps the consumer think about different options and think about their finances in different ways. So I think there continues to be some amazing opportunities to sort of create new products that will shape that behavior for the better, whether it's sort of rewarding consumers for paying down their debt, or sort of helping them sort of have a better way to allocate sort of everyday expenses and recurring expenses on one side, and that we shouldn't be using credit for, or sort of exceptional one-time larger expense, but it's okay to spread over multiple months. So I think we will continue to see that type of innovation. And what I'm sort of really excited about is I think we are going towards more and more transparency in the way products are being explained and sort of made available to consumers. I think being online has really sort of helped in a number of ways. I mean, it's a lot easier to sort of normalize disclosures. There's no side conversation with a person with a teller or someone in person. I mean, everything is standardized, everything is normalized, it's automated. So there's a much greater sort of compliance in disclosure and in the way products are being explained. I think regulators have done a great job also at promoting sort of ways for consumers to file complaints. I mean, the CFPB complaint database was a great improvement in that direction. There are a lot more ways for consumers to voice their unhappiness, which makes, I think, providers a lot more sort of honest in their behavior. So I think we continue to see that, to see products. I'm an optimist.
I am too.
We continue to see products that are more and more transparent and better for consumers, because if our company is any indication, we really feel like we get rewarded for being more transparent and for having products that truly help consumers get to a better place.
One of the things that we saw early on was interest rates, and not paying interest was a real driver of the interest in buy now, pay later programs. But that's really fallen way down the list. I mean, it is this predictability of payment that I think has become such an overriding force, whether it's an installment product or a buy now, pay later flavor of the same thing. That predictability is what consumers really value. We have a couple of minutes for a couple of questions. Are there any questions from anyone in the audience or tuning in online? This is your chance to ask a non-crypto question. No non-crypto questions? Yes, there's one here.
I have a couple questions about the buy now, pay later conversation that we were having. So as I understand it, the BNPL decisions are made off of the soft inquiry. An upgrade strategy for their buy now, pay later strategy, are you guys using other information in that decision, such as how many times somebody has, and maybe that's a little technical, but how many times has somebody had a BNPL extension from you guys, or how many they have currently? And then sort of building on that is, in the case that you're not taking into that into consideration in that decision, are you seeing any mismanagement of cash flows later down the line for individuals who have had that extended multiple times?
Yeah, so our product specifically, so Upgrade Card is not a BNPL product. It's really a credit card, but it's an installment card. So it sort of mimics some of the benefits of BNPL. So obviously we do report payments to credit bureau. We report the open line. We report we report the outstanding balance like any other credit card. But yeah, it's been difficult to make sure that we that any sort of open BNPL plan is taken into account in our underwriting, because again, some BNPL providers do not report to the credit bureaus. In that case, there's very little ability for us to know that it's going on. We get most of the time we get transactional data from the user's bank account. In that case, if there's a specific payment that's taken at a regular interval, we can use that in our sort of ability to repay calculation and free cash flow calculations. But it's not as accurate as if all BNPL providers were sort of reporting plans to the bureau, which I think should be the answer.
So then my next question actually builds perfectly off that, because do you think the impending inclusion of the BNPL data on a credit report, so that now this has the ability to impact your credit score, will lead to decreased use of this product as people start to realize the impact it's having on their creditworthiness?
Possibly, but I think it will also lead to better use of the product, right? I mean, I think those consumers who are like overextended through these BNPL plans won't have that ability to overextend themselves. It's going to end up being a good thing for them in the long run. So I think it's a benefit for everyone really, and there may be a short-term disappointment for some consumers, but I think it's in the best interest of everyone that all these balances get reported to the bureaus.
But I think the question is, every time you want to apply for buy now, pay later, and there's a hard hit to your credit file, that is a ding against your credit. That's not good. If you're a consumer, even if you're a credit-worthy consumer, that's not a good thing.
Yeah, and then the extension of the plan itself helps you recover some of it, right? So you take a hit for the inquiry, then you're getting sort of extended credit in an installment plan, which is also sort of better in the FICO score calculation than revolving credit. So I'm not sure it's a net negative in terms of credit score necessarily. I think it will depend on how often someone gets into these plans and how long the plans are.
Okay, we have the big red stop sign, so I think that means we need to stop. Thank you for being an attentive audience. Thanks, Renaud, for your great.
Thank you, Karen. It was great.